Hello, everyone. Good morning. And for those of you on the East Coast, good afternoon. What we want to do is we want to continue our conversation on how our emotions play a pivotal role in our investments and whatever our investments in. And we want to talk about all the ways that your emotion can cloud your judgment, not just how your emotions are affected by others. But what I want to talk about today is how your emotions can actually skew your personal view and the risk inherent in that. And I want to talk a little bit today about the real estate market. And the reason I want to discuss the real estate market is I've seen a lot of real estate professionals talking quite a bit about how real estate is still a great investment and rates are coming down and things are going to be back to normal and you have nothing to worry about and now's the time to buy and you don't want to miss this boat. And look, I'm not saying that anyone is telling you anything intentionally to hurt you or to misguide you. What I would tell you is this. I put something up yesterday that really just broke down what current market price and rates have done to affordability. And that's really, when it comes to real estate and where you live, the fact of the matter is, if real estate goes out of bounds, if it gets to a place that people cannot afford the monthly payment, because that's what most people consider when they're looking at where they're going to buy, something has to give. Okay. Even last year, before rates had really moved up, early last year, most people were priced out of housing. And what was happening in that time was obviously contracts for new construction, for home purchasing. All these things were falling slowly but surely. And it was simply because price had moved to a place that people couldn't afford. And that was with low rates. Okay. Now we're in an environment where the Fed wisely has chosen to increase rates. And they were supposed to have, I think, 5 rate decreases this year. Most people are saying that if we get one in December, that would be great. Not sure if we're going to get a rate decrease at all. The economy hasn't cooled enough. Yeah, there's been some cooling, but let's face it. If you're looking around at the world around you, forgetting all the economic data, does it appear to you that prices have really come down? Because, for me, I don't see that. And that's the way I live my life. Because remember, statistics can be skewed. You can leave a statistic out. You can go from, they can say, hey, the job market's really heating up. People are back to work. But are you comparing that to when no one was working during COVID, for example? And that's just an example. Because I heard all these great things about employment, but the fact was no one was working. So I sure hope that when we go back to work, that those numbers are greatly improved. But is that really an improvement? It's an improvement over what? And that's kind of how statistics get used in economic statistics. You have to be aware of what you're comparing it to, right? If you look at inflation data, CPI, it doesn't include energy or food. Now, the reason they give you that those statistics don't include energy and food is that they're too volatile. And what that really means is they are heavily affected by inflation. But guess what? Those two things heavily affect your life, but they're not accounted for because they're too heavily affected by inflation. They get too expensive too fast. But guess what? That's your real life. And that's why I say when you look around you, you want to observe the environment in which you live, because that's the most honest way to judge what's going on. All right. So heading back to real estate, when you look around, we're looking for this rate cut, this great dramatic rate decrease. When you look around, does it look to you like prices have really fallen? Has real estate really fallen? Has the cost of your mortgage fallen? No. Let's get back to the post I put up yesterday. In fact, right now, with where housing prices are and where rates currently are, and we don't know when and if they're going to come down, there's a possibility they can go up. The monthly cost of home ownership is 35% more now than it was a year ago when it was already too expensive. Now, I'm not telling you to live your life in a vacuum and don't try to assume what may be coming. But if you're assuming that rate cuts are coming and coming at any speed whatsoever, you're making a very difficult assumption. Because right now, for housing, just to go back to where it was already too expensive, residential housing, commercial real estate's already being hit significantly. Residential housing has to come down 35%. Now you say to yourself, well, why hasn't it come down? If rates have gotten that high, where it's made it that much more unaffordable, why hasn't the residential real estate market come down more? Well, there could be several reasons for that. One, Airbnb created a lot of investors in real estate, and those investors have become landlords and short-term landlords, and they really just began feeling the squeeze of that short-term rental market demand decreasing last fall, last summer. So they haven't put a lot of houses on the market. A lot of them have moved into long-term rentals. But what that's done is that has kept a lot of houses off the market. But believe me, there are a lot of people out there that they require the income that comes with that short-term rental of Airbnb. Otherwise, they really can't afford the mortgage, and maybe they're holding out for now. There's a possibility. Another possibility is corporate America has been buying up residential real estate in very, very large numbers, far greater than any other time in history. And they have the balance, the balance sheet, the cash flow, the cash on hand to sit a lot longer than a person does. So while inflation has risen and continued to rise, and the real estate market has gotten more and more out of reach for the average home purchaser, two things have happened. One, corporations don't pay the same interest rate as you for real estate. They pay far, far less. They're probably still sitting down there at 1% or less right now to borrow money. So that's of great help to them. So really right now, they're paying less than you were paying a year ago to purchase the same real estate you're looking to purchase. So their costs are lower, therefore their risks are lower. That's one. And two, they look out a bit further than the average person can, right? They can look out 5 and 10 years and say, what's the profitability on these houses? What has happened historically? And that's what they look at. Now, there does come a point at which that won't be sustainable, okay? And those might be a couple of reasons that housing hasn't come down. But if you're looking at real estate right now as an investment or even your home, the skewed vision that this is sustainable or that this is going to stay the way it is without just accepting that there's a very large risk in that particular asset is probably tied to your life in some way. And that's why I brought up a lot of the real estate professionals, whether they're mortgage brokers or whether they are real estate agents. The truth is their livelihood is attached to this. And of course they want the best. So they're hoping every time the Fed says they're going to cut rate, of course they're hoping that the Fed is going to cut rates. They can see what you see. However, their livelihood is dependent upon this. And it's not like they're trying to give bad information. They're giving the information that they're given. However, they can see the marketplace the same way I can. The difference being, I'm just giving a completely objective view of what I see. I am I believe in risk management above all else. I am not one of those guys that is looking for the asset that's going sky high. I know better than that. The assets that are moving sky high carry the most risk. For example, right now, if someone asks my opinion on the stock market, I would say it's a very speculative market. You need to be leery and you need to be active. If you're someone that's in there and you're looking for the buy and hold situation, this is probably not a situation that you want to be purchasing in. Okay. Now, that's not advice because everybody's situation is different. But as a coverall umbrella, that would be what I would tell you. And what I would say next to you is that while I agree that AI is going to get bigger and bigger and bigger and more advanced, I would say that is the riskiest asset class in the market right now. And there's a reason for that. It went parabolic. It went parabolic, meaning it all of a sudden, it just took off and starts heading straight up. And I will tell you that anything that heads straight up will come back down, and it will come back down to wherever it took off from. And usually it'll dip slightly below that. And the reason I give this example is so that you realize that I'm not biased towards real estate. It's simply that real estate went up 40% in the matter of a couple of years because the Federal Reserve put 50% more currency into circulation in the US than we had. What does that mean? They just added a bunch of money into circulation. Now, that money, when it gets pushed into circulation, drives prices up, and that is what we refer to as inflation. And how we remove inflation is we remove that currency. Well, what happens if you remove that currency? Well, the assets that went parabolic, that went up very quickly in an unusual manner, should return from whence they came. And you'll see that that works through all asset classes. What I just said will continuously work. Most people will refer to that as a bubble. That's what they'll say. For example, the internet bubble of 1999. Straight up. How long did it take to recover from the internet bubble? Now, this was what you would call a technology bubble. We call it the internet bubble. It's because when the internet hit and technology hit, a lot of people realized this was the way of the future. And they got really overly excited about the fact that this was the way of the future. Everybody was trying to, use it at diapers.com, babysitmykid.com, and everybody was buying everything. And that may be similar to this artificial intelligence situation going on now. And people bought that all the way up. It made a lot of people very wealthy, but it also broke a lot of people. And by the way, how long did it take to come back from that? 15 years before we ever saw those levels again? The buy and hold strategy, it's not that it's a bad strategy or that it doesn't work, and that goes for real estate or anything else, but you do need to be aware of the potential risk. And when me, as someone that is always talking about investments or assets or whatever it is, I always look for risk, because controlling risk in your life, controlling especially areas of high risk, is the goal, or should be the goal, for anyone that is investing their money, purchasing an asset, building a business, what have you, because those things are all affected by one another. So is real estate going to is it going to affect the stock market? Of course. Is AI going to affect? It's a sector, right? AI is its own little sector in the stock market, but will affect the rest of it? Of course. Could it affect real estate? Sure. How? Well, if you have, for example, Silicon Valley, when the tech bubble happened, what happened, and actually for the next 20 years, what happened was it took Silicon Valley, the San Francisco, the Bay Area, and it pushed housing prices through the roof. Why? Because most of those people were involved in that industry. And as that industry took off, they were able to push prices higher because they were so profitable. The same thing could be said for Detroit back in the 50s. The same thing could be said for Pittsburgh, Pennsylvania in the 60s and 70s with the steel mills. So Detroit cars, Pittsburgh with steel. These things affect, they all work together. They all affect one another. And you have to look at assets or investments or anything you're doing as a whole, right? It's not just, hey, I'm going to buy and sell this. It's how does it affect the economy? How does it affect your overall portfolio? How does it affect your life, right? And so there are many, many strategies you can utilize to protect yourself from this. But what you need to realize is how it affects you emotionally. So we always talk about emotions, or I talk to people about how their emotions influence what they purchase, their assets, their investments, what they buy, what they sell. And what you have to always be cognitive of is how your emotions about a particular investment or asset might be affecting you. So if you're a homeowner and that has been your biggest savings has been your home, do you think that seeing your house appreciate by 40% in the matter of a couple of years made you a little excited and made you think, wow, look how my wealth has grown. And then if someone were to come along and yuck your yum, as we love to say in my house, and tell you that that's not sustainable and that will probably come back down, would you be likely to want to hear that? Would you like having that feeling of happiness challenged? I mean, most likely you would not. And neither would I. Neither would I. The only difference would be that when I look at anything, when I'm looking at any investment, when I'm looking at any asset, anything I'm looking at, I am always looking to challenge myself. I want to prove my opinion wrong. That's the lens I look through. I look through the lens of I'm wrong. Let's prove me wrong. Let's hear what this person has to say, and let's prove me wrong with information. And so if somebody came to me and I had an affinity for real estate and they said to me, Derek, housing is 35% more expensive than it was in early 2023. And in early 2023, it was already unaffordable. That right there for me, because of the lens I'm looking through, which is let's prove me wrong. I want you to prove me wrong. I will automatically throw up the biggest red flag. And so if I were to challenge that, the only way I could challenge that is to say that I believe that the market, the real estate market, is going to soar another 40% in the next 2 years because rates are going to drop. And I would automatically say that that is very, very unrealistic, given the economic climate, right? That's very unrealistic. And then I'd say, B, well, that would only get me back to where we were in early 2023. Given these facts, given how simple that fact alone is, I would say that real estate's a very risky investment at the moment. Are these things impossible that I just laid out? Could those things happen? There's a probability for anything. Nothing's impossible. But what I have already proven to myself is that there is a very, very large chance that I'm wrong and that real estate has to come down significantly. Even if rates get pulled back to where they were a year and a half ago, which is highly, highly unlikely, real estate has to fall 15, 20% just to become affordable. Now, if rates stay where they are, I could potentially be looking at a 50% plus drop in real estate. Objectively. So what I'm saying to you is just that simple fact alone, which everyone is able to realize or everyone's able to look up. This isn't complicated stuff. With that fact alone, knowing that real estate is a risk asset, I automatically turn that on in my mind and I say, okay, so you probably want to evaluate whether or not you should own any of that or not. Now, if you own your home, obviously you own your home, right? You keep paying for it. But I think from an objective point of view, you can see how emotions in that particular market, it sort of creates a trickle down effect. Okay. It starts with the people that work and pay their bills in real estate as a profession. Right. And you have to look at where that advice is coming from. And is it a little skewed? Because we all want to protect our families. We all want to protect our lives. And if something seems scary, we don't want to admit it. And you also have to say, okay, from the public's point of view, how could they possibly have an emotion towards this? And you say, well, you know, if I had a 40% run up in my largest asset, I'd be pretty darn excited too. And I wouldn't want to challenge that. And this will help you learn to paint a clearer picture across all assets when you're looking to invest or purchase or own or start a business. And the way you can do that, there's several ways. We just talked about the fundamental picture right now. And I look through that lens always as well. I am not just a chartist. I say that because the word art is in the middle of chart, and I like that because it is an art. It is reading a language that very few understand. And so if I go in and I start looking at real estate and I start looking at markets within real estate in the book of of investments, right? Which is the stock market, which is where institutional money is putting their money or taking money from. I can go in and I can verify my thoughts. And that's why it's so important to learn how to find that footprint of that big money. We talked about that second tier yesterday. We talked about banks who are heavily affected, obviously, by real estate and lending. We talked about hedge funds. We talked about CTAs. We talked about financial advisors. That's kind of that second block. And that's what people will refer to as big money or smart hands or strong hands. Apologies. Strong hands in the market. There's another layer down there, which is market makers. And in this particular instance, they don't have much bearing. But that second tier, those are the people giving the advice to the retail investors, which is the third tier of any market, the consumer, effectively, the buyer and seller of those assets and investments. So you just have to be aware of these facts. And I think this really brought home how emotions could affect what you're doing, because if you're an owner of real estate, of course you want to protect the idea that your wealth has really took a rocket ship up 40% in the last 2 years. If you work within real estate, you want to protect your income, your family, and your livelihood. And on the other hand, the opposing side that may actually try to attack that is someone who's looking to take real estate investors and turn them into another sort of investor. Now, they are going to be talking about all the things I told you about and then some, because their goal, obviously, is to have you put your money elsewhere. Now, for me, I never look at it in those terms. I look at every asset as an individual, and I give my best assessment of that asset, because I have no vested interest in whether or not someone invests in real estate, invests in stocks, invests in crypto, invests in bonds. It makes no difference to me. I simply offer my opinion on what I see in the world, which does give me a bit of an edge. And doing this for 25 years, I know how to challenge myself the right ways and really challenge my opinions. And that's what enables me to keep emotion out of that equation. And I can just look at it for what it is. In any case, I hope everyone enjoyed this live. It'll be posted, I believe, on all the channels. I hope you learned something. If you have questions, please leave comments. If you have any concerns or anything, please reach out to me. I'm happy to help. And I want to talk about one other thing, which is, financial plans and how they can help you to avoid these scenarios. Because we talked yesterday about having a financial plan. I always talk about that really as the foundation for anything that you're doing. And the reason is this: if you have your home in your plan, in your financial planning, you have your investments, and then maybe you own some other things. You own some crypto in there, you own some gold in there. What you'll see in that financial plan is, if it goes askew, meaning all of a sudden it looks like the most amazing plan in the world, and you can look at one asset in there and you can say that is the asset that made this all possible. Look how it's moved. You really have just identified the way that where risk is. Because anytime anything takes off, goes parabolic, goes straight up, changes that plan, you're aware of the fact that that should come back to where it took off from. And also, when you're rebalancing your assets, you know that this particular asset has gotten way out of control. Okay. So if you own that in a very liquid portfolio, if you're trading in one way or another, you're able to take money from that asset each time you rebalance, which pulls risk off the table for you. So as you rebalance, you are pulling risk off the table because it's gotten so out of hand. And you're also putting it into assets that are doing well, but they're not doing as well. So you can see how a financial plan can also protect you from your own emotions. Okay, because you have goals set, you have a certain amount of money going in, and you can see, or when you set up your rebalancing, you can see that, wow, this asset has really, really risen. So that's another way to control your emotions. I hope it adds to that. You can head to my website, which is prometheaninvesting.com, and check out my Investing Like a Pro course. I make it very inexpensive so that everyone can afford it. It will walk you through the process of setting up a financial plan, why you set up a financial plan, how to choose which investment vehicle, meaning IRA, Roth IRA, individual account, joint account, how to set up an account, how to make trades to buy your assets, and then how to choose those assets based on different asset allocation models, and then finally how to rebalance those assets. Right now, I have a Mother's Day special, so it is on sale for $97. Again, you can go to Investing.com and check out that course. I will probably be live again later tonight, and typically I put up the code for the course, but today I forgot to add it, so I'll be sure to add it tonight. I hope you enjoyed that. Again, if you have any questions, leave comments, like this, follow me. All of that helps me keep this going. If you enjoyed this stream and it did help you, please, if you're not looking for a course, you're not looking for any type of education, donate. Donate to help me keep this sort of thing going. I like doing this, and I like to continue doing it. It is very helpful, obviously, to have income coming in while I do it. So thanks again, everybody, and we'll see you later. Any questions, concern, please reach out. I'll probably be live again tonight at some point. Thanks a lot.